Indicators are used to spot trending markets. That's where we're looking for trend continuation. To spot overbought and oversold markets, that's where we are looking for trend reversal. And to analyze market moves and make decisions. So the first is the most basic, and that's moving averages. The most common indicator, and most traders are going to look at two types of moving averages. A simple moving average, which is the average of closing prices over a given period. So if you're looking at a 7-day moving average of the last 7 days on the euro against the dollar, you take the closing price of those 7 days, add them together, divide by 7. Easy calculation, and that gives you the simple moving average. Exponential moving average is exponentially weighted, where it takes the closing prices, but there's going to be more weight given to the most recent close. The idea behind that is the most recent trading prices are going to be the most relevant, and instead of each day having the same weight, it's going to be exponentially weighted, so the most recent are given more weight in the actual average. Moving averages help traders identify trends in two ways. One, by viewing price in relation to the moving average. Some traders will just use the moving average to help see how price is relating to the actual average of that market. Where if the price is above that moving average, then they might be bullish and might look for to use strategies that identify uptrends, or if we're below that moving average, we might be bearish. And others will look for short-term, long-term moving average crossovers, combining two moving averages to identify opportunities. Now, most traders that I know do not use moving averages alone to make decisions, but instead they often will use moving averages as building blocks for strategies. So if you get more into strategy creation, this webinar is based on chart reading, how to determine the direction of the market, but strategies will pinpoint actual entries and exits. Many traders will use moving averages to build upon strategies that they intend on using or that they are testing. Here's an example of an 8-period moving average and a 20-period moving average. And this one happens to be on Google for the few of you who trade stocks. Now, if you take a look at this chart, this is actually a couple months old because the market's come off of those highs. But the price alone, if you got rid of these moving averages, it'd probably be pretty easy to see that the market's in an uptrend, right? But this is where, as traders, sometimes it might seem as though the market's in a move, but difficult to make decisions. And so moving averages can help make those decisions, because the short-term moving average should be above the long-term moving average in a strong trend. And here we see that that's exactly what happens. Throughout this move, there's a few times we get close, but throughout this very nice move of almost 200 points, the short-term moving average was above the long-term moving average. So if you're looking at moving average crossovers, when the short is above the long, we could look for the market to trend up. If the short's below the long-term moving average, we could look for the market to trend down. Here we see the most recent example of Google, and you see that really just looking for these crossovers can be effective, because even though it gets a little dicey here, we have the low cross below the short-term moving average cross below the long-term moving average here. And what do we also have? Well, a few things going for us. Drawing trend lines, we could identify a downtrend. Using crossovers, we could identify a trend or a trend. And look at this. Even if we use these lows as support, a breakthrough support, it's just a matter of getting comfortable reading the charts to identify your trading opportunities. Now, I mentioned that some traders might use a moving average to reference price to see where it is in relation to that moving average to be bullish or bearish on the market. And this was just used as an example, a 30-day moving average. And we see that in a trend, most of the closes are above the moving average. Every now and then you get one close below, but you didn't get two consecutive closes below in this entire move up, right? And then once we did close below twice, now that trend has changed. Well, you don't need the simple moving average to tell you this if you're comfortable drawing trend lines. Look at I mean, the trend line basically tells you the same thing, but the trend line might even be more effective for you and easier to draw. So there isn't a right or a wrong here. It's what helps you make decisions on the trend of the market, what you feel most comfortable with. The trend line, for some people, could be much easier to apply and very effective. For others, maybe it's looking for 2 closes below the moving average or 2 closes above the moving average to help in direction. Well, Paulie, I think that that's a good concept. Paulie says Dr. Elder talks about using moving averages for getting a fair price for what you want to buy or sell, and that's the concept behind using a moving average to reference price.